Welcome to this ValueBridge.net case study. Last time we looked at a cross-border value bridge where the limited partner was a US-based public pension. They invested in a fund manager based in Europe who acquired a company that operates in Spain. Dollars first go from USD to Euro and then into the company, and when the business was sold, that capital made the return trip. We measured how much value creation came from things that the manager can control versus the broader market impact of valuation multiples, addressable market changes, and foreign exchange rates. This time we'll show you how to get to the same answer more quickly and using a lot less data. Previously, we started with a table like this. It's full of company capital structure, income statement, and market data. Inflows include the initial platform followed by an add-on acquisition. And outflows include an equity distribution followed by the exit. Then we measured how these metrics change over time in terms of differences, averages, and equity return multipliers. We plugged the differences and averages into the equations for the derivative model of value creation. This gave us 9 different value drivers that form the basic value bridge, where value creation components bridge the gap between invested capital and realized capital. Then we rearranged the value drivers, placing the market drivers on the left and the manager drivers on the right. And we consolidated them into a market-driven return and a manager-driven return as follows. From here, we converted USD of value creation into the different value creation measurements, like relative or percentage value creation, and then equity return multipliers, and finally into value creation IRRs. Now, let's do the same analysis with the logarithmic model of value creation. The equations are a bit less intuitive, but they provide nearly identical results and they do it with a lot less data. In fact, we can eliminate more than 2/3 of the rows on this table. We keep fund equity value, or FECV, how much the fund invests and returns in the base currency of Euro. Then we use foreign exchange rates to convert those inflows and outflows into the home equity value, which is the LP's native currency of USD. Then all we need are the broader market multiples, which contracted from 8.4 to 8 according to a report from an investment banker, and the relative change in the company's addressable market, which increased by 14.5% over the hold according to economic data that we use for a proxy. The foreign exchange rate multiplier is 0.9986 over 1.1524 or 0.867. The multiplier for the market multiple is 8.0 over 8.4 or 0.952. And the addressable market multiplier is 1 plus 14.5% or 1.145. The market-driven return multiplier is simply the product of these 3 numbers, which is equal to 0.945. This is the multiple of invested capital that you would get if the GP had no impact on the deal. The fact that it's below 1 means the GP is performing against broader market headwinds. The deal returns 2.455 invested capital in the LP's home currency USD. So we can calculate the manager-driven return as 2.455 divided by the market-driven return of 0.945. This gives us a manager-driven multiple of invested capital of 2.599, which is a more accurate measurement of the GP's value add. We can now convert these to any other value creation measurement. For value creation IRRs, we need the deal's effective holding period. So we take the natural log of the deal's gross multiple of invested capital and divide by the natural log of 1 plus the deal's gross IRR. This gives us an effective hold of 3.731 years. A value creation IRR is the equity return multiplier raised to the power of the reciprocal of the effective hold minus 1. So total gross IRR in the home currency is 27.2%, the market-driven IRR is minus 1.5%, and the manager-driven IRR is 29.2%. Relative or percent value creation is the natural log of the multiplier divided by the natural log of the multiple of invested capital in the home currency. So relative value creation in the home currency is 100%, relative value creation driven by the market is minus 6.3%, and relative value creation driven by the manager is 106.3%. Finally, absolute value creation in the home currency is equal to the 80.5 million increase in USD times relative value creation. So total absolute value creation is 80.5 million, market-driven value creation is minus 5.1 million, and manager-driven value creation is 85.6 million. Unlike in the derivative model that we used last time, we were able to calculate all of this with absolutely no information about the company's revenue or EBITDA margins or debt levels, and our results are basically the same. Here is absolute value creation for the 2 models. Here is relative value creation. Here are equity return multipliers. And here are value creation IRRs. Okay, with all of this said, which model should you use? Well, if you're creating content for GP marketing materials, it's probably best to go with the derivative model that we used in the last case study. Even though these equations have more variables, they will be easier to explain and defend to LPs, lawyers, or regulators who might have questions about your math. That said, the logarithmic model equations in this case study are entirely defensible, and they are scalable, so you can use them to quickly evaluate many companies at once. In the next case study, we'll show you how to do that by building a cross-border equity return matrix. Thanks for watching. I hope you found this helpful. Make sure to check out the case study page at valuebridge.net for a downloadable Microsoft Excel template and a complete demonstration of all the mathematics.